with the current state of the market, what are you pushing right now?
The thing that I'm coaching my team, my lending team, the hardest on is cash out HELOCs and first time home buyers. People are willing to pay 10, 11, 12% to get rid of a 20 to 24% loan. People are stressed every single month that they can't pay their bills. People are not getting raises as fast as their payments are going up, and they're under pressure financially. It's summertime, they want to go on vacation, they want to travel, they want to go see their family and do things, and they don't have the money to do it. So either people looking to buy in this market because it beats renting, or people that need secondary financing to get rid of all the debt that they accumulated over the last couple of years.
Have you found any challenges as you're trying to push these products, and how do you when you're pushing a HE loan right now or a HELOC, what are some of the challenges that you're facing as you're interacting with the customer, and how do you overcome those? An example could be they don't want to take the 12%, or they they feel like
I think
this
I
isn't the
understand
right
what you're
time.
saying. I think the biggest thing, and I coach my team on this almost every day, people get stuck on what the loan details are versus what the loan is doing for them. And so if someone tells me or tells my team, let's say, they don't want 12%, instead of saying why not, we have to really identify what the 12% is doing for them. So if you're paying off all your bills that are 20 and 22%, I almost laugh and be like, well, why wouldn't you want a 12% late rate? Well, it's high. Okay, well, do you want $5 in your bank or $10 in your bank? I want 10. Okay, so if I'm saving you money or we're lowering your payments, what is it to you that the rate's 12%? That's the going market interest rate. Your payments are going to go down. So if the person's saying, and you don't try and say, why don't you want 12? Why don't you want 13? Why don't you want 14? The only argument that they might say is, well, I can get cheaper elsewhere. And instead of fighting with clients like LOs do and say, no, you can't, it's say, okay, great, where? Where are you getting a cheaper rate? Well, I saw online. Okay, well, that's advertising. Here's what the market rate is. And I've learned over the years, when you just tell people like the honest truth, I used to not do that. And not that I was ever dishonest with the client, but you tell them what they want to hear. No, this is the best you're going to get. Like all like that stuff is silly sales stuff. If you say, look, Howard, I understand that you want a lower rate. I'd love to give you a lower rate, but all I can do is give you my God honest best, right? And the God honest best I can give you is 12%. I'd like to stop focusing on the fact that it's 12 and focus on the fact that it's saving you $1,000 a month, and focus on the fact that you don't have a mortgage person you can turn to, and focus on the fact that in 6 months, you'll trust me to bring this down. And instead of telling you I can do better or go back and forth and try and get an exception, I'm just going to be honest with you and tell you this is the best I can do. And I think that it helps you. And if you stick with me, I'll stick with you. What do you say? And clients will be like, well, this is a straight shooter. They want straight shooters more than they want the lowest interest rate. And I think that's what we have to realize in this market. We try and battle the terms and look like a car salesperson that goes back and forth with the client. Well, if we just tell them this is the best I can do, but I'm not done with helping you, they appreciate that 100 times more.
Yeah, I like that. I've just had my team go through a sales training with me where I said, let's role play on what happens when a client asks you, why is my rate 7%? And that was it. That's what the rate is. Rates suck, huh? We're gonna refi you in 6 months. Let me show you what it's gonna be when I get this opportunity. With talking on high rates, maybe you can shine some light and give me some knowledge on a little bit more back end of why rates are where they're at, and like in the news they're talking about something called the debt ceiling, and like what is that, and like how does it affect us in the mortgage space, and Like how is that affecting our marketplace, or is it just the new thing in the media that's trying to scare everybody like COVID?
So let's start with what you said, scare. The word is fear. People react to fear. If I ask you for $100,000 or $1,000, whatever is a lot of money to you, you're going to say no. If I pull out a weapon, that's fear. You're going to give me your money. So right now, the fear is that the government will not have enough money to pay its bills. What people don't realize is, why is the government having a tough time paying its bills? Well, the Federal Reserve is not the government. They're two separate entities. The Federal Reserve serves the government, but they make monetary policy. The government does not make monetary policy. So the Federal Reserve has been raising interest rates in order to slow down inflation. That we all can understand. But when they raise the interest rate, people don't realize that if we have $6 trillion in debt and the rate goes up by 1% on that $6 trillion, that is $70 million more a year, or a month rather, that the government has to repay. So they keep raising rates to stop inflation. They're doing so, but now the monthly service on the debt goes up. So if the government borrows $5 trillion from the Federal Reserve for COVID, they have to repay that money through collecting taxes and other things. But they also have to service the debt, like a loan you or I would get. So right now, the government is running low on money because in like what our representatives do, our leaders of this country do, is they set a debt limit and they say, here's the maximum money that the government can freely borrow from the Federal Reserve. Because if they have no limit, then they'll just borrow so much money, our currency value will tank. So they have to go up, that debt limit gets squeezed because cash reserves go down. Just like you or me, if our rate goes up on our credit cards, what happens to your cash? It goes down because you got to service your debt every month. So right now, everyone's afraid. And if the government defaults, let's just say, and they don't raise a limit, it can't afford to pay its bills. What are its bills? Its bills are its employees. Its bills are its debt to its creditors, like other countries. And its bills are also like Social Security. So if you're someone that's retired and your employer is the government, you get pension or Social Security from the government, and your employer goes bankrupt, how are they going to pay your Social Security? So that's the fear right now that's in the marketplace, is the government will not be able to cover its bills. That's the genesis of that. So any questions on that part of the question? Does that make sense?
No, that makes sense.
Okay. So now how does that affect our market? Well, the value of our dollar would tank if our government can't pay its bills. And so that's putting pressure on the markets right now, because the reason why the US is such a strong economy is it's the world's reserve currency. It's the most stable currency out there. And if our currency becomes unstable, then we're not the world reserve anymore. And we become a financial less than world power. So it sucks because they can't pay their bills. It sucks because we aren't the reserve currency. But will they reach a deal? I can't see how they won't, because it would be catastrophic to our economy if it does. But does it affect people on their day-to-day life? Not really. As long as they raise it, they aren't dipping into your pocket. How will they get that money back? Well, as the Fed start cutting rates eventually, it becomes easier to service its debt. And they have to put together a good plan for reducing their overhead. But I mean, look, they just hired 65,000 IRS agents. They just advanced all the student loan debt money. So all these things are things that seem like they're free money, but they're money that we as taxpayers eventually have to pay back at some point.